Okay, I woke up to a news that didn't go well with the financial market. Both the stock market, the cryptocurrency market are down. In short, most assets are going down, especially the risky assets. So why? Because the Fed Reserve they finally put a wheel in their motion for balance sheet reductions. So this is actually a perfect time for me to do this video. And I bet you would see the other side of market crash that you could actually make money from. So in this video, I'm going to talk about how to trade the market crash. That's what this video is going to focus on. How to trade the market crash. Can one still make money in a market crash? My answer is yes, you can. So why most people are focused on the bullish run, which is when the market is going up, I think you can actually make money in a market crash. Now, I'm going to show you how to take advantage of that opportunity, both in the cryptocurrency market that is down and also in the stock market. But you need to be very, very sure of what you're doing, number one. And this strategy that I'm going to share with you, it's not a long-term strategy because the market had always been in a strong uptrend. So you're taking advantage of the moment. So my own definition of moment is this time that the news is hot between 1, 2, 3 months. So as long as the factors that are going to drive the market down are still there, you are leveraging that moment until it wanes off. So that's why I'm going to teach you how to trade the market crash. Now, before I move on to show you the opportunities that are in the market crash, I want to also show you or talk about how that the market always reacts to the US Federal Reserve. So if you want to become a professional trader or an investor, there is one regulatory policy that you must always follow back to back. In short, they tend to affect the global economy, and that's the US Fed policy. US Fed policy. Fed policy is always they always react to whatever that is happening in the economy. You understand? If the economy is going so strong, everything is going well, price of things are going up and all that, and US economy seems to be stronger in terms of growth. What happened? Fed begins to watch, especially inflation. So when Fed sees that inflation is hitting certain level that is unmanageable, that is not acceptable, what happened? They come in with their own policy just to tame or find a way to curb that rising inflation. And when that happens, the market reacts. So the market had always been reacting to this move a long time ago. So now, what is this Fed policy all about? Let me show you how it all started and where the whole thing has led us to right now. So let's go back to March, the peak of the COVID era. Then you can see here around March 2020. So I'm going to launch my chart. So let's start with the SPS charts. So this is SPS. That's the chart of S&P 500, top 500 companies in the US market. So you will see that the time that this Fed, you can see Fed Reserve cuts rates to zero and launches massive 500 billion quantitative easing. So what they are doing is that they are trying to bail out a lot of companies. They are trying to put funds, they're trying to pump money into circulations and all that. And they're trying to encourage businesses. They want to encourage economic growth. They want to push the economy. So when Fed is looking at putting more money in circulation, making money available to everyone, they look at interest rate cuts. They try to make interest rates so affordable. So a layman, it means when you go to the bank to borrow money, the bank is not going to charge you higher rates. The bank is making loan cheap. So it's like loans are very cheap right now. So you can go and if you want to build, if you're into real estate, you can go to the bank, you can go to your financial advisor. So money is available everywhere. And when money is available everywhere, what happens? There is higher money in circulation, and their purchasing power increases. And that's one of the reasons you've seen the trend in inflation, money in circulation, and all that. And that has always been driving a lot of assets that always go up during inflation. So look at what happened here. Federal Reserve cut rates to zero and launches massive 700 billion quantitative easing. That was in March 2015. Now look at the SPS too. You can see at the peak of the COVID era, February, notice how SPS crashed from 3,346 basis points to a low of 2,300. And in 15th of March, so let's go back to 15th of March when that announcement was made. So I'm going to take my chart back to, so look at it here. You can see 15th of March. Notice, okay, look at it. You can see after that announcement in 15th of March, you can see how the market picked up at exactly that point. So which means that the growth in this market was largely driven by US Fed after they launched their 700 billion quantitative easing. And also, so a lower rate is always bullish, is always supportive of stock market growth. And what happened? The stock market and cryptocurrency market, they've shown over time that they have a direct relationship. So you need to also understand intermarket analysis. That's one area you need to understand if you want to be a professional investor. You need to know how the US Fed policies drive, how it drives the US dollar itself, and you can always find that on dollar index, and how dollar index tends to affect the stock market and also the cryptocurrency market, including the bond market. So after this launch, the market rallied higher, and we can also go back to March in cryptocurrency market. So this is total. Total is the index that tracks the overall crypto market. So let's go back to this chart now. In May 2020, you can see again how the cryptocurrency market crashed in February. And from there, after that announcement in March 15, you can see here the market picked up. So both the cryptocurrency market and the SPS markets, they all picked up at the same time. They all picked up at the same time after the US Fed announced that policy. So that tells you how a lower interest rate tends to drive the market to the upside. So if you follow this market, you will see that the US Fed has always been a major driver of the financial market. So now we've always seen how that different media have been reporting inflation data. So let's look at inflation headlines around inflation. So I'm going to call it global inflation rates. Okay, look at this headline again. Rising inflation widespread globally, but US stands out. So this was December 14th. So a lot of CBNs of different banks and medias have been carrying that news around how inflation had been surging to new highs, from rising oil price to rising gas price, and a lot of things, even consumer goods are also going up and all that. So that became a concern that the US Fed had to step in. So you can see first that from then, how notice how the market had rallied so strong, which is the SPS up to now. And then you also notice how the cryptocurrency market had rallied from that low of 145 billion from 2020 to the high price that it attains today. So this increase has been driven by the US Fed after the March rate cuts and also 700 billion quantitative easing. Now, now what happened? Another headline again. You will see again that the US Fed now is now looking at rate hike to address inflation, to curb inflation. So after US Fed meeting yesterday, it was seen, or a lot of analysts saw the minutes of that meeting, and they noticed that the US Fed had actually voted. It's been confirmed that they are now going to increase interest rates. So if this rate cut could drive the market to the upside, what do you think will happen when there's a rate hike? Your guess is as good as mine. The market is going to crash. So that explains the massive crash that we're seeing right now. So you can see here, Dow drops nearly 400 points in first loss as trader brace for more aggressive Fed. So the Fed is now going to be aggressive in its policy. What does that mean? It means that they are going to reverse this quantitative easing. So if they are launching this, if they have launched this in March, it means they are looking at cutting down their they call it tapering. So we're looking at cutting down quantitative easing. Whether it's going to be aggressive or not now depends on them. But the whole truth is that the whole fact is that they are looking at cutting their support. Number two, they're also looking at rate hike, which is the opposite of this. So if this has moved the market to the upside, what do you think will happen when they increase rates? It will push the market to the downside. So which is what we're seeing here. So yesterday, you see that most of the indices were down, both the Dow Jones, Nasdaq, S&P 500, the even across the globe too. And also the cryptocurrency market was not left out. You see how the market crashed yesterday by almost 5.87%. That's the overall cryptocurrency index. So the question now is, what should I do at this point? What's the best thing to do at this point? Is the news still hot? That's the question you need to ask yourself. So that leads me now to the main topic, which is how do you trade market crash? How do you take advantage of this market crash? So let's start with the stock market, the equities market. So look at the stock market, SPS. Now, SPS had been in a very strong uptrend with the 50 days sitting above the 100 days and the 100 days clearly above the 150 days. So does that mean we are still in a bull run? Yes, we are still in a bull run. Notice that we've had several dip in the past. Look at this. We've had a dip in the past and the market continues to rally higher. So what I'm looking at right now is I'm looking at the market establishing a strong support around these points. I've already mapped out a key level area first. Now notice how the market rallied from this point up to this level right here. This was, I think, the period of Omicron and all that. How the market rallied to this level, pull back, rally back to this level, then pull back again. So this is a major resistance, and then the market eventually clears that level to form a new high. Right now, the news it's not favorable. Investors are reacting to that news, which is why the market dipped right now. So I am looking forward to a market that will dip that will dip further in coming days or week as investors react to that news. And if you look at the medium-term charts of S&P, you see that the S&P has rallied so high. So there is need for the market to correct itself. So if the market is going to correct itself, the first major correction should be 4,532, which is this 4,532. Then if this does not hold, then we're looking at another major correction to 4,300. So let's map out 4,532. 4,532 sits around this point. So I'm looking at the market correcting back to this major point right here. If this 50 days does not hold, that's this point. So 4,532 from this point down to this point. And also, if this does not hold, the worst correction will be back to 4,371. So now that we have been able to establish that S&P 500 might dip because this is not going to be favorable. Higher interest rate has never been good, or it's never good, and it's not good for the stock market. Why? The reason is simple. Cost of borrowing is going to increase. And what does cost of borrowing mean in a company's book? It means higher finance costs. And higher finance costs is going to cut down your profit. It's as simple as that. Now, for companies that are exposed to debt, that's why I do not advise my community members to buy into companies that are too exposed to debt. When you're too exposed to debt, times like this are not really good for you because you have to pay higher rates on your borrowing. So that's why you need to be exposed to companies with lower debt. So that times like this would give you opportunity to take advantage of low level companies or low geared companies that are trading at the lower end of the market. Now, how do you know companies that are not exposed to debt? It's not about the actual amount. Oh, this company has a debt of 100 billion. This one has a debt of 20 billion. Oh, this one with 20 billion is lower. it's low geared, or it's not really exposed. That's not how to check or compare companies that are exposed to debt. How you know companies that are exposed to debt basically is by looking at interest margin, interest cover. That's what you look at. So the ability of the company to generate profits that can pay back its interest comfortably. And then you also need to look at the cash sitting in the balance sheet. That's also very important. So first you look at debt to equity. What's the equity position of the company compared to debt? That's number one. Number two, you now need to look at interest cover. Interest cover is how the company is able to pay back. How many times can the company pay back its interest from the earnings before interest and tax? So if the interest cover is above 2, then it means the company is covered. And then if the debt to equity is less than 1, then, or sometimes you say less than 1.5, then this is a good company. But if the company that has 20 billion has debt to equity of 5, and then interest cover is less than 1, maybe like 0 point something, then the one for 20 billion, it's more exposed to debt. So you don't look at debt by figure or nominal figure, or by using these two metrics that I just shared with you. So right now the S&P 500 is in a downtrend, although the moving average still tells me that the trend is still bullish for now. But with the index dipping as high as 1.94. So I'm projecting a deeper crash to 4,000, 4,005 something, within 4,000 basis points from this level. So 4,700 minus 4,500, that's like 200. So 200 divided by 4,700. So this is like 4% correction. So we might see a deeper correction by 4% to this level. That's for the SPS. Now, how do you then take advantage of this particular correction in the market? Now, the only way to take advantage of this correction in the market is by looking at what we call inverse ETFs. Inverse ETFs. Now, inverse ETF are ETFs that go up when their base, or when the main asset that they are tracking goes down, and also goes down when your asset is going up. Let me give you an example of one of the inverse ETF that I have right here. Okay, so I have the Nas. Okay, let me look at one that's okay. I have the Russell 2000 index. Now, what is Russell 2000? Russell 2000 is an index that tracks the performance of small cap company. 2000 small cap company in the US market. So 2000 small cap companies in the US market. Now, you will see that this index has been going up. You can see from the beginning of January right here, 2020, you can see how this index rallied from 193 and then closed the year around 220 basis points. Now, this is for the US company, 2000 small cap companies, Russell 2000. Now, you can see how the index closed below the 50 days moving average. Notice this, how the index closed below the 20 days and 50 days moving average. After this average had acted as support, you can see the downtrend. So my own definition of uptrend or short-term uptrend is when the 50 days above the 100 above. When it's lined up sequentially like this tells you that the market is going up. At some point, you'll notice how the market started consolidating. So if I draw my trend line to connect this level, see here, and then another trend line to connect this important key level. So you notice that the market had been, after a rally from January, you can see how the market has been trading within ranges. You can see here. Why? Because investors are now concerned. So you can see how that's why small cap stocks in the US actually underperformed Dow Jones index. So as we look at the market dipping at this point, this is a very important level to watch out for, which is 212. So if this index dips below 212, we are going to have a confirmed short-term, because you can see that the market has been trading within ranges for a while, between February and December, for almost a year after it had rallied from October to this point. You can see how the market started trading within ranges. So I think investors are actually reacting to the pending news that was early last year. So as market trade within ranges, I'm looking at the market breaking out from here. So if it breaks out from this point, this is going to provide another opportunity. Now, Russell 2000 is one of the major index you need to track in the US market. We have the SPS for top 500, we have the Dow Jones, we have the Nasdaq for tech, we have the Russell 2000, that's 2000 small cap companies. So if this index dips below this point, this is going to provide a massive opportunity to trade an inverse ETF of this. And what's the inverse ETF of this? The inverse ETF is RWM, which is short Russell. You can see here short Russell 2000 index. You can see right here. You can see how also how that the short Russell 2000 index had been trading downward compared. So let me launch two charts to demonstrate that. So you can see here, you can see how this index has rallied between September up to January. You can see the uptrend and go back to this point too. You can see again between September up to January, you can see how it has traded down. So I can also draw my key level right here. So if this index dips below this point in reaction to that Fed rate hike, you remember, notice what is driving the market right now, the Fed rate hike, then this should provide ample opportunity to trade this particular index. So this is the first index that I'm recommending right now. So with this index, you are able to short Russell 2000 index. So as Russell 2000 ETF itself dips, this index is going up because this is an inverse ETF. So it goes up when the market pulls down. So that is one index you need to watch out for. It goes up when the market pulls down. So this is one index to buy. Now, another index that I'm going to share with you right now is DOG, short Dow 30. Short Dow 30. Now, Dow 30 is another index that moves in opposite direction with the Dow Jones. You can see here Dow Jones average. So you can see how Dow Jones average had been on a long-term, short-term uptrend and also long-term uptrend too. You see right here. So at this point, if Dow Jones dips below the average and we see a sign of cross to the downside, which means the Fed investors are reacting to the Fed rate hike, then this is another index to buy. Shorts. So when you say short means you are betting that the market will go down. And if it goes down, you profit. So what this index do is that they have been designed in such a way that as the overall market go down, they are going up. And as the market goes up, they are going down. You can see how they have been largely bearish because the market had been going up for a while. So this is another index to look at. This is another index to look at right now. Then the third ETF that I'm mentioning right now will be the EUM. The EUM. What is EUM? EUM is to short emerging market index. Emerging market index. EUM is already showing a sign of a bullish run. So what is emerging market index? This is an index that tracks all other indices in emerging markets. So emerging markets, basically developing markets. So when the US Fed increases rates, do you know what happened? People are going to move their funds away from emerging markets because interest rates will not be attractive. Fixed income markets in the developed market like US is not going to be attractive. People want to put their money in bond because the rate is going to be higher. People are going to put their money in money markets. So when they pull funds away from emerging markets, what happened? Emerging market begins to go down. So this index actually shorts the emerging market, meaning that when the emerging market is going down, the index goes up. You can see how the index went up yesterday by 1.7. You can see during the market crash, the index went up by 1.7. So if the index eventually clears this major resistance, you can see it has a major resistance around this level between August. You can see how the market has found key level. So if the market clears this 13 level, so we are looking at a big uptrend. So all these index are available for a buy on your broker platform. So if your broker support ETF, this is the best time to do that. I have checked all these indices on our local brokerage platform, like on Bamboo. They are all on Bamboo. So watch out for this index. If they eventually clears this key level that I've mapped out, this will be the best time to buy them. So why others are selling, why you are also selling to hedge against your existing portfolio, you can also move some funds to this particular index so that you can leverage on short-term bull that will be driven by US rate hike, because I think this move might be a bit aggressive from what I read online. So, but I needed confirmation by looking at key levels. So if the market is eventually going to break the key levels that I marked right here, then this will give you ample opportunity to buy into the short ETF. So let's recap the ETF again. The first one is EMW, which is the short Russell 2000 index. Sorry, not EM, RWM. So this is the first one. So you can see I have my key level mapped here. If this index is able to break this 29.96, 22, then it's a confirmed uptrend. The second one is DOG, to short the Dow 30 index. You can see again, you can see right here. So if this index is able to clear each of these moving average, so for me, I have my major lines drop here. So if it's able to rise above 33 right here, then there's a confirmed bullish run. So I need to have a bullish confirmation by seeing this index rise. You can see how the index has traded largely above these averages. So you need to go above, you need to move above all these three averages for me to have a confirmed bull run. And then the final one is the EUM, which is the emerging market index. So the emerging market index right now is at this point. So these are the opportunities you have in the market right now. So if the Fed rate hike become something that will be of major concern to institutional investors, there's going to be a lot of portfolio restructuring, which should create opportunity for you to make money in the market. So why your other portfolio is going down because of the crash, you can also use this to hedge against that crash by buying into inverse ETF. So that is for stock. Now, in the cryptocurrency markets, you also notice how the cryptocurrency market had also dipped in same factor. Investors are reacting to that rate hike. Now, one thing about the cryptocurrency market, it's even more volatile. It's more volatile than stock, and you need to be very careful. The cryptocurrency market moves in opposite direction with the US dollar index. DSY. So the dollar index is an index that tracks the value of US dollar against basket of major currency. So as at yesterday, the dollar index closed by 0.08. That's to the upside. As investors are now reacting to that rate hike, the value of the dollar will now strengthen against major currency. That's why I told people here in Nigeria that now is the time to allocate more funds to US dollar. Now you need to move more funds from naira to the US dollar, because this rate hike is going to drive our dollar exchange. Investors are going to move on. You can see already that one of the index we are shorting is emerging market index. So that tells you that investors are going to move funds away from the emerging market to developed market. So dollar index is going to strengthen. You can see how the index had been moving up. So I have a major downtrend line around this point. Look at how so even though dollar index had been in a long-term downtrend, you can see here still below my trend line. Now, with the market closing at 0.62%, if this index eventually close above 96, maybe 97, then we have a bigger run to 100. So this should also provide ample opportunity for you to trade the ETF that I mentioned earlier, because this is going to be bearish for stock markets. So if the index eventually clears above or trade above this trend line, it's not going to be good for stock market. It's not also going to be good for cryptocurrency market. So that is why the crypto market had been down, just like you see on the chart, because a higher dollar index tends to be bearish for crypto. You can see how the dollar index had been trading higher right here. You can see, and that also, you see, from November, and then you can see right here again, which tallies, although it's been going up from June, and then around November it became stronger. So this also explains why we've not had impressive performance in the BTC market. Even though the market closed at 60, it's still good, but against what we expect, how the market dipped from all-time high of 60,000 to close at 40,000. The market would have closed higher by almost 100%. But because of this strength in US dollar index, because of US Fed policy, note what is driving this right now: the US Fed policy. That's what is driving the market at this point. So what are the opportunities in the cryptocurrency market? Now, the opportunity in the cryptocurrency market is that you can also trade inverse leveraged ETF. So you can, like BTC right now, we have BTC down. So BTC down is a leveraged ETF. So yesterday, why BTC dipped by a larger percentage, BTC down went up by 1.62%. You see here, you can see 1.28%. And if I drill down to my monthly chart, you will see that the BTC down had been up by 17.95% in the last 1 month, while BTC itself is down. So BTC down, it's a crypto that is like you are shorting Bitcoin itself. And I can also go back to mention BNB down. So BNB down is also another index. You can see BNB down is up by 18.41%, while BNB itself is down. So you don't just jump in to start buying each of these crypto. For you to do that, you need a confirmation. Confirmation is very important. Now, what's my major confirmation in this market? My major confirmation is if this market closed below. So you can see that BTC had a very important key level at this point. You can see here has an important key level going by the previous dip here, which tallies with this region. So if the market attempts to retake this region 1.9 again and it dips below 1.9, so that's an opportunity to go buy BTC down and BNB down. Although there are also inverse cryptos, cryptos you can short in the market, but I just mentioned these two as one of them, so you can check out other ones. We have STC down, we have LTC down. These are cryptos that go up when the market is going down. So that is how to trade market crash. You need to look at inverse ETF. So with inverse ETF, you quickly hedge against your portfolio. So as the market keeps going down, while you're holding the other side, you are leveraging on that inverse ETF to make some money. And by the time the market starts reversing back to the uptrend, you quickly sell off, and then while watching your other portfolio pick up later on. That's if you were caught in that market crash. But overall, the long term, the market still remains in a very strong uptrend. So let me show you the SPY. The SPY had always been in a strong uptrend right from time in the last 10, 15, 20 years. So you can see, let's go back to monthly chart. You can see the monthly chart from 1998. The SPS had always been in a very strong uptrend. So this is like a normal pullback. So what you're doing is you're taking advantage of the short-term pullback in the market so that you can make money and then sell off while also holding your portfolio to ride this long-term uptrend. The market has always been in a strong uptrend. Stock market is not crashing forever. There will always be pullback. We've had pullbacks here. You can see, imagine you bought inverse ETF between this point down to this point. Imagine you also bought between this point down to this point. Imagine you also bought from here down to this point. And then look at this again. So this is why you need to look at the market from this perspective. So when you take advantage of short-term opportunities like this, you're able to cut down the losses on the other end, at the other end of the market, which is the one you have bought to ride the short-term uptrend. So I hope you got value, and I hope this video makes a lot of sense to you. So please, if you are yet to subscribe, kindly follow, subscribe to my channel, and then you can also like and share this YouTube because I want as many people to see this at this time that the market is going down.